Thank you. Hi, everyone. Thank you all for joining my session today on how to raise funds in a post-pandemic world. It's a big topic, so the focus for this session is on startups that are confident in surviving the next few rounds and intend to raise funds now or in the next 18 months. For startups that are still going through some uncertainty, we can talk about that later on in the Q&A, or you can reach out to me after this session. But some of the ideas that I will be sharing here will still apply. But first, before we begin, I should introduce myself. I'm Victor Ng, Chief Commercial and Strategy Officer at Fundnel, Southeast Asia's largest private investment platform. I joined Fundnel in January this year after more than a decade as a VC, and prior to that, I was an entrepreneur and a corporate finance professional. So when I speak on today's topic, I'll be putting together perspectives from all sides of the table, having sat in these different seats over the last nearly 2 decades. Now, raising funds in the post-pandemic world is a big topic, and I've broken it down into several parts to make our subsequent discussion easier. We will start by first looking at the effects of the pandemic on business innovation and how this has impacted fundraising activity. We will look at how investor expectations have shifted as a result of the pandemic, how startups should adapt to find a new normal in their industries, and some useful frameworks you can consider using when pitching to investors in a post-pandemic world. We will then, of course, talk a little bit about the fundraising options available, and I'll try to be unbiased about this to give you some useful perspectives depending on your circumstances. And I'll aim to run us through the slides in about 25 minutes and leave around 20 minutes for Q&A. Now, COVID-19 has had a debilitating effect on the economy. I'm not going to run through the numbers on economic impact, as you can feel it and read about it every day. What is interesting, however, is that despite the obviously challenging economic circumstances, stock markets seem to have maintained an irrational exuberance. What you see here is a chart on how stock market prices in the US closed quarter on quarter on the Nasdaq, S&P 500, and Dow Jones Industrial Average. Since the end of March, stock markets have rallied strongly to regain most of the losses in the first quarter of 2020. In just 6 months, with global economies still in the midst of recession, the stock markets are back to where we were at the end of 2019 in the US, before COVID happened. All this despite the fact that COVID-19 infections and casualties continue to rise with no clarity on when enough vaccines will be developed and deployed such that the virus is no longer an active threat to our daily lives. Now, why does this happen? The simple answer is expectations. This is well-known economic theory, but also common sense. If you expect that tough times are ahead, you will save more. And if you think that times are getting better, you will save less and invest more. But expectations don't just drive the stock market. They're also what drives economic rebounds and downturns as well. Back in February, I wrote an article about this on LinkedIn as a response to all the gloom and doom that many investors were prophesizing and calling for. Now, expectations are particularly important to startups because startups are building for the future. If you're building a business in the travel segment right now, for example, you probably want to know how the expectations of consumers and investors have changed in this space. Not only that, you probably also want to know how the sentiments of other stakeholders have changed. For example, how are airlines planning for the next 18 to 16 months? How are hotels thinking of the same period? What are they investing or not investing in? All these will influence the way that industries shape out. At Fundnel, we're running a series of webinars to help investors and entrepreneurs hear from each other on this. You can head over to our website and sign up on our mailing list if you would like to be kept in the loop. But let's go back to the data a bit. Since we're on the topic of expectations, in the spirit of spreading some positivity, I want to go back to the data and see if there's any room for rational optimism. Now, the natural reaction for most people is to think that an economic downturn is a bad time to invest in startups. And the PitchBook survey in April showed this as well, with 35% of investors surveyed believing that their fund's pace of investment will fall by more than 10% in 2020 compared to 2019. But some of the most notable names in tech today were founded during the last financial crisis. You recognize names like WhatsApp, Uber, Airbnb, and Slack. All these were companies that were founded between 2007 and 2009. And if you're an investor, and kept your wallets open and invested in these companies, then you would have done very, very well for yourself. The leading VC funds know this. At the same time as they issued a warning to their portfolio companies, through March this year, Sequoia Capital has invested $3.4 billion and raised a $7 billion fund. Lightspeed Venture Partners, another famous VC fund, raised more than $4 billion for 3 funds to focus on early and growth stage opportunities. In this region, Vickers Venture Partners raised around $200 million for its latest fund and continues to fundraise. BNext, an up-and-coming player in the region as well, raised $160 million for 2 funds. And these are just some examples. So for the entrepreneurs in this audience, the next time you meet an investor who is cautious because of the current environment, you can remind them of this. Now, in an industry like venture capital, where there's a persistence effect on performance, meaning if you are deemed to be a good fund, you are likely to do better, I think this persistence effect will increase further, and the bifurcation between top quartile funds and everyone else will increase. That means that the investors that are active in the market now are likely to be the ones with the fortitude and dry powder to continue business as usual, or even ramp up the pace of investments. On the other hand, the investors waiting on the sidelines may have not just a more pessimistic view of the economy, but also they may be pessimistic about their own chances of raising more funds from LPs, and therefore in the mood to conserve cash. What about for entrepreneurs? Is this a good time for starting a business or raising funds? Well, I can't predict the future, but there are some positive signs. We spoke about the top tier VCs who have managed to raise significant amounts of capital to deploy during this period. And this is on the back of a VC industry that was sitting on around 190 billion in dry powder just 6 months ago. On top of that, if you compare this current economic crisis to the previous one, our financial institutions are in much better shape, largely because they aren't the cause of the crisis this time round, and we have a strong government funding in many countries to support startups and SMEs. In Singapore, for example, we have the $200 million special situation fund for startups that the government has set aside to help startups, although details for how that will be dispersed are, I'm not the best one to ask about that. In Malaysia, the Securities Commission increased the upper limit for equity crowdfunding and doubled the government co-investment amount to support startups, which I think is an excellent stroke of government policy as it creates greater market involvement in allocating capital to startups that are worth investing in. Also, different sectors in different geographies will see different impacts from COVID-19, driven mainly by changes in expectations. According to a study by BCG FinTech Control Tower, new equity funding raised as of June 2020 actually increased 19% year-on-year to reach 462 million. In fact, startup funding remained strong in the US, Europe, and China in the first quarter of 2020, but it's forecast to soften in the next 6 months. However, I don't think that quarter-on-quarter numbers are necessarily always meaningful for analyzing startup investment activity because deals can take quite a few months to close. And I imagine they may take even longer in this climate as investors work around using online-only tools to do their due diligence. In short, investors are not fleeing the markets, but are instead changing their behavior and expectations to re-optimize their investment strategies. Now at Fundnel, we're constantly talking to investors to understand their sentiments. In fact, just last week, I moderated a panel for Wild Digital precisely on this topic. From the conversations we've been having, there are 3 broad observations I would like to share on how investor expectations have changed or are likely to change in a post-pandemic world. The first observation is that investors expect startups to do whatever it takes to survive. Part of that is massive cost cutting. Even startups that have raised a tremendous amount of funding are cutting jobs. Airbnb, Grab, and Gojek are just some of the more prominent and recent examples. Related to this, investors say they are willing to lower their expectations of how startups perform post-pandemic. I'm not sure I believe that though. At the end of the pandemic, investors will still favor the startups that have emerged stronger. I doubt that the pandemic will be equally bad for everyone. It's like driving in a race car and there's suddenly a wet stretch of road. Every car will slow down, but some cars that have tires suited for wet weather will pull ahead. At the end of the day, investors will still bet on the winning cars. And I think we see signals of that happening somewhat in the public markets as well. The 5 biggest constituents of the S&P 500, Microsoft, Apple, Amazon, Alphabet, and Facebook, were already leaders at the start of the race. But in the last few months, they have pulled ahead even further and now account for 1/5 of the entire of the entire index's market cap. These are the companies that have benefited from the social distancing responses to COVID-19. These are the race cars with the wet weather tires that are pushing their advantage to pull ahead of the race even further. The second observation is that investors are expecting better deal terms in what is now a buyer's market. I don't think this is a function of COVID-19 alone. Instead, it is part of an expected shift of bargaining power from startups to investors, which has perhaps been a decade in the making. Venture deals are complex. Just looking at headline valuation numbers can be misleading. But what we are seeing are investors asking for more investor protection in the form of milestone-based financing, anti-dilution rights, and other types of economic and control rights to protect them from risk, while at the same time seeking more participation in the upside. The third observation is that investors will expect startups to make significant changes to their strategy to adapt to how industries will change. And we will talk about that a little bit more in the next section. Just a second ago, I spoke about how investors expect startups to work towards a new normal in the industry, a new normal that's forming as a result of the pandemic. I want to spend a little bit more time on this because this is really important when you think about the message you want to communicate to investors as you raise funds in a post-pandemic world. The big question is, what will this new normal look like? And in this regard, I think Professor Scott Galloway over at NYU has a great take on this. Now, according to Scott, things won't change as much as they will accelerate. While other crises reshape the future, COVID-19 is about making the future happen faster. The almost overnight boom in Zoom and Slack users is one example of this. Working from home used to be taught as an interesting culture that was only slowly taking root, but COVID-19 changed that overnight. The Institute for the Future, based in Palo Alto, has some great frameworks to help you think about the future, like this framework here that I like called Right Two Curves. It won't be perfectly accurate, but it might give you a sense of the scale of change that COVID-19 has brought about in the way we do things. When you plan for your new strategy, an easy way to think about what the new normal will be like is to start by drawing out what you think the long-term trends of the industry will look like in 10 years. And imagine what will happen if all of that was accelerated and happened in the next 2 to 18 months. Some people call this field of work futurecasting, and it's probably never been more important than now. And after you've mapped out what the expectations of the new normal are, you will still need to think about how to adapt your strategy for this new normal. At Fundnel, for example, we've seen our users triple their engagement rate in the last 2 months. While part of that has been our ability to adapt to the new normal, it's undoubtedly true that investors have also become much more aware of the efficiency and possibility of finding and making good investments through online platforms like ours. Now, how have we adapted? Let me share some of my views, this time from the perspective of a business builder. And to be honest, we figured it out through a process of strategic learning, which involves a lot of experimentation and trial and error. But last week, I found this 2010 framework from the Harvard Business Review that explains well what we did at Fundnel. The HBR framework describes 4 approaches to steering a company through a recession. Prevention-focused companies primarily make defensive moves and are more concerned with avoiding losses. If you look at what many investors are advising, they're essentially asking companies to take this approach. Promotion-focused companies focus more on offensive moves, continuing to aggressively ramp up during a crisis. Pragmatic companies combine defensive and offensive moves. So you cut a little less than a prevention-focused company would and invest less than a promotion-focused company would. And finally, progressive companies deploy the optimal combination of defense and offense. This is, of course, the holy grail. Now, Fundnel's approach has been to cut unnecessary costs and implement zero-based budgeting for new initiatives, enabling all our team members to keep their jobs. We've pivoted our growth strategy in terms of direction and timing, and continue to hire key personnel that will help position ourselves to run strong out of the gates once the global economy rebounds. I think we only know in hindsight if we hit the optimal combination, so for now, I'll label us as pragmatic. because certainly that's a word we would use to describe our strategy. So does HBR agree with the advice that most investors are giving? The short answer is no. HBR found that prevention-focused companies grew at half the rate of progressive companies and were significantly less profitable after the crisis. I think the lesson here is that cost-cutting isn't enough. If you survive but end up behind your peers that have done more than just cut costs, it may be a Pyrrhic victory anyway, as you may struggle to raise funds even when the economic situation improves. We've talked about how COVID-19 will accelerate changes in the industry, and we've talked about the need to balance offensive and defensive strategies in managing through the pandemic. Now, as you plan your post-pandemic strategies, it's also important to look out for macro drivers outside your industries that are also being accelerated. Two such macro drivers come to mind. The first is the decentralization and localization of supply chains. We saw the first seeds of this in the ripples of discontent over the unequal distribution of the benefits of globalization. Now, what the pandemic has done is to accelerate trends of decentralization and localization by adding a more pressing, visible reason to support these trends. The second is the accelerating importance of ESG. Yes, Enterprise Singapore, but also environment, sustainability, and governance issues, which have really come front and center during this pandemic. We saw how much a global lockdown can do for the environment, and yet how little it will do to help us get to the level of carbon emissions we need to get to collectively as one globally connected society. As you plan for your post-pandemic pivot, it will be helpful to keep this in mind. Take this as a good chance for you to play your part for society by seeing how you can incorporate strategies that align with ESG values, because in the new normal, what's good for society and environment will likely also be what's good for business. Now, in the last section, we talked about how you need to adjust your strategies for the post-pandemic world, not just for pitching to investors, but also to survive and thrive in whatever the new normal becomes. So how do we put that into practice when we pitch to investors? Pre or post-pandemic, I think some of the basics of pitching are the same. At Fundnel, we occasionally run pitching workshops for startups, which we have built around a framework we simply call the Fundnel 5P framework. For today's session, I'm going to walk you through the most important frameworks quickly and then simplify the workshop for you through a very brief example. The Fundnel 5P framework is a simple and intuitive high-level classification of the factors underpinning our proprietary machine learning algorithm that powers Fundnel's deal-making engine. Basically, we take hundreds of factors in our algorithm and classify them into just 5 for ease of explaining the model. These 5 factors are potential, people, product, performance, and publicity. You will find that every good pitch will intuitively touch on some of these factors, but which of these factors are more important depends on the stage that your company is at. For post-pandemic world, we'll add a 6P, pivot. This captures what we spoke about in the previous section, which is how you've responded to the challenges of COVID-19, both in the present and for what you expect the future to be like. But it's not good enough to just lay out the facts. A good pitch is first and foremost a story, and good stories often share very similar elements. In our workshops, we talk about how the hero's journey, a storytelling template popularized by Joseph Campbell, has used some useful elements to draw from in crafting the outlines of a good pitch. Now, I've simplified it to draw out the elements that your startup story should contain. You should start with a strong hook to catch the reader right off the bat. There has to be the prospect of riches and adventure. It has to be believable but not mundane. It has to seem destined or inevitable on hindsight, like how accumulation of all the trials and tribulations were just preparing the heroes for the challenge in front of them. And usually, it has to have a simple but clear vision of what drives the heroes to go on this adventure despite the hardship expected. For me, for example, I invested in and then later joined Fundnel because I want to build next generation capital markets in a way that would encourage you and I to work together with investors and entrepreneurs to use capital and ideas to shape society positively. And finally, every story has at least one major moment of conflict and how the heroes overcame this conflict. So let's put some of these concepts into a structure for pitch that's especially useful for deep tech startups, though it can be applied to any startup, really. First, start off with a relatable analogy that shows why what your startup is working on matters to the world. Even better, if you can demonstrate why it matters to the investor personally. Essentially, this is you telling the investor the so what of what your startup is doing. For most startup stories, this is your hook. If your so what isn't strong, or if it positions you differently from how you would like your startup to be seen, this will affect how successful the rest of your pitch is. Next, introduce yourself and explain why you and your team are the right team to solve this problem and how much effort you've already put into that. The last thing an investor wants is an entrepreneur that says, yeah, I've had this great idea for years, and the only thing I need to validate is money, your money. Show instead how determined you have been at using what little resources you have to try and solve this. Then finally, you can explain this problem in detail and talk about who it affects. Most startups make the mistake of making this the first part of their presentation, but without setting the context, the so what. It's difficult for most investors to see the benefits of the solution or the pain caused by the problem in the same way that you do. And if they don't get it, they won't be interested to find out more. The rest of this template is not difficult to understand, so in the interest of time, I won't explain it here. But what we do at our workshops is that we overlay lessons from the Fundnel Pte framework onto this template to create basic, intermediate, or advanced pitches to match the level of sophistication of different investors. So if you're interested to go deeper on these workshops and receive some one-on-one coaching with my team, connect with me on LinkedIn and I'll set you up for the next one. Now, so far, we've talked about putting together a pitch. Where do you find investors to pitch to? I promise to give an unbiased view of fundraising options. So let me lay out in brief the various options that are available right now in this region. It's not really that hard for me to be unbiased because what options you choose really depends on the situation that you find yourself in, based on the stage of growth and how much of cash runway you have, amongst other factors that could be at play, both internally and externally as well. But first, before you look at the options available, you want to familiarize yourself with and consider carefully whether you should raise funds through issuing equity or debt or applying for government grants. Government grants can help startups in a variety of different ways. Obviously, at an event like this, I won't be the expert in the field, but I can briefly share what I know. Particular to startups, government grants are extremely helpful for developing proof of concepts, for deferring research and development costs, for improving organization efficiency, and to upgrade human capital. That for startups comes in many different forms. You have bank financing, P2P financing, venture debt, and convertible notes from investors. You want to look closely at the terms whenever you take on debt financing, but in particular, look out for whether the loans are secured or unsecured, and if any PGs or personal guarantees are being required as part of the terms. Equity is what most investors use to invest in startups. And this is probably familiar to most of us here, so I won't elaborate too much on this. What I think is worth highlighting is that you should choose your investors carefully because these are the people you will be working with for the next couple of years. And it's a professional relationship that is going to be very, very hard to quit, since unlike a loan, you usually can't pay back investors or it's really costly to do so. In our pitching workshops at Funnel, we talk about what to look for in an investor, and we also talk about the nuances of some of the more common deal terms you'll face, but that's just too much detail for this short session. There are also two more types of funding instruments worth talking about that aren't talked about enough, so let me introduce them as well. SAFEs, or Simple Agreement for Future Equity, are contractual agreements that have the least risk for startups, but typically used only in very, very small rounds of financing. Customer and suppliers are also an important source of financing. If you're Tesla building a new electric truck, for example, you might be able to get your customers to finance you directly through pre-orders. But for the rest of us, crowdfunding platforms is a commonly used way to help you access customer financing. Supplier financing is theoretically also possible, but usually only if you have a strong relationship with the supplier or strong bargaining position. Of these 5 types of funding, startups at different stages tend to gravitate towards different combinations. But this is just a rule of thumb, and there are always exceptions. As I said before, there are many factors at play for an optimal financing strategy, And you really shouldn't fall into the trap of thinking that there's only one preferred approach. But I will go ahead and share some of the more common approaches based on growth stages anyway, just to get you a sense of where the baselines typically are. Now, very early stage startups, for example, should probably tap on government grants actively, launch crowdfunding campaigns, and turn to angels and incubators for any additional funding necessary. When raising funds, instruments like safes or convertible notes are more founder-friendly, as they typically delay you having to agree to a valuation with investors at a stage when it's really hard to value your company based on just your potential. Startups that are looking for Series A funding and beyond can, of course, tap on their own networks or look towards platforms like Fundnel. The advantage of platforms like ours is that we connect you to many more investors than you can find on your own. I often say that fundraising is a game by which you need to accumulate enough no's to get to a yes. And being able to reach out to 13,000 investors through one single platform helps with that. What about distressed startups though? I mentioned at the start of this masterclass that this segment of startups won't be our focus because the topic is more complex and outside my area of expertise. That said, I've seen some investors coming in to pick up startups in distress, but these investors seem to be using private equity style approaches, which I'm not sure apply very well for startups. If you're a distressed startup right now, one of the best outcomes is likely for an acquisition by a strategic investor, as recently happened with iFlix and Tencent. But that's not really something that one can hope for, of course, especially if you're very early stage. The key difference here, I think, is to make sure that the main people driving the business, either founders or management or early investors, remain sufficiently incentivized to continue turning around the business. Otherwise, any new money going into the company is probably throwing good money after bad. There are also some fun alternatives, such as Matchbox VC, that matches entrepreneurs to investors through a game of Fortnite and other similar types of games. I can't recommend this as I don't know how effective this has been, but as an investor myself, I can't imagine why playing a game of Fortnite with someone would make me want to invest in their ideas. I guess in the old days, the equivalent of this would be to match investors and entrepreneurs over a game of golf. But in this case, are you supposed to be good or pretend to lose to a potential investor? I don't know. Maybe someone in the audience can do an experiment and let me know how it goes. Jokes aside, one of the positives for startups that COVID-19 has brought about is that it has brought the world closer, even in lockdown. There was an article in the Financial Times earlier in June that talked about how VCs in Silicon Valley now find it acceptable to do due diligence virtually. That's great news if you're looking to connect with VCs in Silicon Valley or outside of wherever your company is based. And of course, you can trust that Fundnel is helping you to build inroads there. Okay, that's the end of what I prepared to share with you. Let's start the Q&A.
Thank you, Victor, for your very unique presentation. Maybe please invite you to remain with us to respond to some questions. Here's a question from Andy. Actually, it's a dual-prong question. How do we work with Fundnel, or how does Fundnel help startups raise capital?
Let me just address this very briefly. So any startup can come to us through our platform. Our website is www.fundnel.com. Go there and you will find the steps that are necessary for you to register yourself as a fundraiser. But what happens after that is that the information you submitted will be put through our proprietary algorithm. We will screen that preliminarily, and then we will give you some feedback whether or not we will be able to proceed for the fundraising. And if we do proceed with that, we'll sit down with you and work out a fundraising strategy that suits your particular startup situation. Because what we believe is that every startup deserves a customized fundraising strategy, and we want to work with you to optimize your chances of being able to fundraise.
Okay. A question now from Lee Rong. What are some of the do's and don'ts for startups, which are very important, especially during the fundraising phase?
I think the most, I would say, there are many, many important things. I would say, first and foremost, choose your investors very carefully, because who you have on board determines very much what your trajectory is going to be like in the next couple of years, right? And make sure that it's someone that you have rapport with, you can trust, you can tell when things don't go right? And someone who really understands your space. So one typical example I always give for early stage startups when they talk to investors is this investor asking you all these interesting questions, as I put it, right, about your numbers, your traction, and all that, and what kind of numbers are they looking for, right? So I think by virtue of the fact that the early stage investment space is somewhat of a nebulous space, and many people know that, some investors have taken to trying to add some science around that. But you really have to understand as an investor that that's not really how the space works, right? If you talk to a seed-stage startup and ask for traction numbers, of course they can give that to you, but are those numbers meaningful? Does that assume that the startup has the right model and that they should never pivot from what they're doing, even if it turns out that there's a better strategy that's more appropriate for them? So all these are questions that you can use to try and understand how good your investors are and whether they understand your industry and have a good fit with you, and whether they truly, truly believe in what you're trying to do and truly, truly believe in your team being the right team to do that.
All right. Thank you for that, Victor. Here's a question from Lynn. How can startups choose the investors and type of funding that best suits them, or which is a better fit for them?
So we cover this in detail in our workshops, but you start off really by understanding what your own requirements are, right? So figure out what your strategy is and figure out what are the types of investors, right? Are you looking for a strategic investor? Are you looking for a financial investor? What kind of investors are you looking for? What kind of value add specifically, right? Before you even talk about the kind of investors, you look for the value add. I often say that what investors bring to a startup typically are capital, perspectives, networks, and opportunities, right? So what you really want investor capital is something that I think across the board all investors are able to provide. But what you really want are the investors that are able to bring you the connections, right? That will help you in the specific way that you want, and perspectives I think is a close second. But I would say oftentimes that investor advice is not always going to be right. At the end of the day, founders know the business best. So investors are just providing a sounding board and a perspective, but that's not necessarily something that you should always follow or take.
Thank you for responding to that, Victor. Here's another question from Aaron. Which sectors will get more interest from investors in the next few years, and what should the startup do if they're not in these sectors?
I think it's an interesting time, right? So obviously there are some sectors like the travel industry, for example, will have a lot more risk for investors at this point because it's harder to really predict how that industry will shape up. On the other hand, if you look at healthcare, especially anything related to COVID-19 or prevention of communicable diseases, obviously those sectors will be hotter for investors. But that said, I think what's interesting about this current time is that there's almost a reshuffle of cards, right? So whatever thesis an investor may have had in the last couple of years about how every industry will shape up, any savvy investor will know that that has to change. So because they know that that has to change, that means that they need to start looking at different kinds of companies that they've never considered before. So I think this is really an interesting chance for startups to differentiate themselves by the quality of how they think about the future and use that as a way of connecting with investors that believe in your version of what you think your industry will shape out to be like.
Here's a question from Jyoti. What are some of the big success stories who have raised financing through Funnel, which you can share with us?
I'm not sure I'm actually allowed to say this here, or rather, maybe you can scoot over to our website, and I think that will give you a better chance to see what are the ones that I was allowed to say. But just spare me on this for now.
Nilesh, a question from Nilesh now. Do you feel that not being able to meet face-to-face is a barrier juxtaposed at this moment for investment deal flow? Are investors prepared to invest without even meeting the founder or the founding team in person? Untangible.
That's a good question. I think it really depends on the individual investor, right? So some are, some aren't. I don't think there's a formula for doing that, but this is something I think you just have to try. And so far, from our experience, like I said, in the last couple of months, the meetings that we have facilitated, the interest from investors shown on our platform for deals on our platform has tripled, right? So I think in general, investors have become much more receptive, but on a case-by-case basis, it's difficult to tell what profile of investors will be more willing and what profile will not be.
Victor, thank you so much for your great session today, especially also answering these questions from those who are joining us. It's been a pleasure hearing and speaking to you. Thank you very much once again for taking time in joining us today, Victor. Wishing you all the best.
Thank you.
Ladies and gentlemen, this marks the end of our panel and speaker sessions, but our exhibition is still ongoing. May we please invite you to take the time to head on over to our exhibition hall to check out our 30 exhibitors. They once again will be up till 5 p.m. today. In the meantime, we'd like to thank you for spending time with us here at SG Innovation Community Day. May we wish you a great day ahead, and please stay safe. Thank you very much, and goodbye.